Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. The tariff roller coaster rolls on. The dollar extends losses after its biggest plunge in 3 years, with treasuries and stocks under pressure as uncertainty hits U.S. assets. President Trump acknowledges tariffs may cause transition problems, but says, quote, "We're in very good shape." Plus, Spain's Prime Minister visiting Beijing today, calling for solid and balanced relations with the European Union. This as China's president reportedly plans to host top EU leaders in July. Good morning. Happy Friday. From Liberation Day to Liquidation Day, investors dumping U.S. assets, equities, treasuries, the dollar, all dropping in unison. Yes, futures stateside are putting a little higher today after the losses of between 3.5% and 4% on equities. But again, the focus on the bond markets, the focus on the dollar, and the moves around the currency space have been extreme. European futures, let's start there before we unpack what's been happening in terms of FX and fixed income. European futures pointing higher by 0.4%. You had gains by the end of the close yesterday. They were faded, but still ended up about 3.5%. Let's see if we can build on that today, given all of the uncertainty and the fact that the euro is now jumping to the highest level versus the US dollar in about 3 years. FTSE 100 futures focus on commodities. The squeeze is there, apart from gold, which is benefiting as a safe haven. FTSE 100 futures pointing higher by 0.3%. Stateside, S&P E-minis then, after the losses of yesterday, just flat, essentially, pointing to very modest gains of 0.1%. We'll see how that adjusts through the session. Nasdaq 100 futures now in negative territory by the skin of their teeth. Let's flip the board and have a look cross-asset then. The 30-year stateside has seen yields up 40 basis points since April the 2nd. The 30-year closing in to 5%. 489 right now. Speculation in the markets about foreign selling. We'll see if there's any evidence of that. Euro dollar at 113. That's the highest level versus the US dollar in 3 years. The single currency is surging 0.9%. The Swissy bid yesterday, the biggest surge in a decade for the Swiss currency. It rallied more than 4% versus the US dollar, currently at 0.81 and gaining again in the session 0.6%. Gold is a clear safe haven as assets are relocated out of the US and liquidated. 3,209 right now on the yellow metal, close to fresh record highs, up more than 1% so far in the session. Let's cross over right now to Asia. The Nikkei is in focus. Yen strength with that currency also bid. Abraham Hong standing by in Singapore to break things down for us.
Yeah, Tom, Asia equities and currencies have been on quite a ride this week, given the back and forth on tariff headlines. Today, we're seeing Japanese stocks, the underperformers, because of these concerns with the US and China, the two biggest economies going head to head, not backing down. What is this going to mean for the global economy, especially the export-reliant economy of Japan? And given the yen strength, the rally that we're seeing, that's the pressure you're seeing on Japanese stocks. But the region's benchmark is still headed for weekly declines on a day where Chinese equities actually not faring that badly. They are holding up remarkably well, all things considered. We had the White House clarifying that these tariffs on China, 145%. The performance you're seeing here, partly to do with this idea, I think, that given the trade ructions, the back and forth, ultimately the biggest losers are the dent in investor confidence for US assets. So maybe China not doing as badly. The idea of policy support as well. Flip the board. Take a look at the Chinese tech stocks. The Hang Seng Tech is on its 4th day of gains. So continued recovery. And today is being helped by a jump in chip stocks. But word of caution, we are still really far away from the peak in March. And analysts have also pointed out that it's still this risk of tit-for-tat retaliatory action. And we're hearing these murmurings, right, that for Chinese stocks, you could experience forced delistings on U.S. exchanges. So those are key risks that investors are still keeping close watch on. Flip the board, take a look at the currencies as well, because today we've been watching very closely the PBOC's messaging. Given the dollar slump, there were expectations that we would see a fix that was 400 pips stronger than the day ago, but it was only slightly stronger by about 5 pips. And the messaging, MLive's Mark Cranfield says here, is that despite whatever is happening in the wider world, The messaging from the PBOC is that they want to guide quietly the depreciation of the Chinese currency. Tom.
Yeah, looking to avoid that disorderly unwind for the Chinese currency, even as they use it, arguably, as something of a pressure valve, given the tariffs, of course, on Chinese exports. Ava Hong in Singapore with a market check. Thank you. President Donald Trump, meanwhile, saying that his tariffs may cause transition problems. He's conceded that, but he has expressed confidence in his plan after the White House clarified that US tariffs on China have risen to an eye-watering 145%, just in term 2 of President Trump, by the way. The staggering import taxes on the world's second largest economy have triggered a tit-for-tat trade war, unnerving, of course, global financial markets. Trump says he would like to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Let's get more and bring in Bloomberg China correspondent Min Lo. Min, the key question then, we keep hearing from Trump that he wants to get a deal, he wants to have that phone call from Xi Jinping and the team. What are we hearing from China? How willing, how close are they to picking up that phone, to making some moves, to getting a deal done?
Yeah, so President Trump has said that he is waiting for Beijing to make that call. Meanwhile, the Chinese Commerce Ministry has said that they are open to having dialogue as an equal partner. But if the U.S. is not ready for that, they're going to fight till the end. So it looks like both sides are waiting for the other party to extend the olive branch to make the first move to create that opening for dialogue. And I just don't know when that is going to happen. But for now, though, China has responded by retaliating with restricting the number of imports of U.S. films, which is an interesting move. First of all, it is a high-profile move with very little downside for China. It could mean that these Hollywood films could lose maybe about 10 to 15 or 25% of their global revenue. And the wording there from the Chinese Commerce Ministry is that they are going to moderately reduce it. So some analysts say maybe China will still import the big blockbuster films to whet the appetite of Chinese consumers, something they desperately need to do now, and just restrict the smaller films. But of course, this is also a signal that China may be widening the scope of the trade war beyond tariffs to the services sector, because that is where U.S. has a trade surplus with China. It's in the services sector, things like transportation, IP royalties, travel, for example. We are also seeing it expanding to the financial services sector, given that some of China's retaliation has been announced just ahead of U.S. futures trading hours. And now there are speculations that maybe Trump could consider delisting Chinese companies from U.S. exchanges as well. And if China feels that the tariffs are so prohibitively high that further tariffs are just not going to make any marginal impact, we could see this economic war really expanding to different fronts.
And we're seeing at the same time, of course, amidst this economic war between the world's two largest economies, attempts by other nations to repair or at least build out trade ties outside, beyond, to offset what is happening with the US. And we've got the Spanish Prime Minister in Beijing today, and he has already attracted a lot of Chinese investment into that country, at least the Spanish government has, and he has been calling then, alongside China, for close relations. The Spanish Prime Minister calling for close relations between Brussels and Beijing. What do we know about the importance of this visit and what it tells us about whether or not the EU and China will move closer?
Yeah, we got the introductory remarks earlier just in the last hour. So President Xi telling Sanchez that the world is seeing changes unseen in a century and calling for cooperation to stabilize the global economy. And Sanchez is making this trip to China in defiance of threats from the US, from Scott Bessent, saying that any tilt from the EU towards China is equivalent to cutting your own throat. And still, Spain is going ahead, saying that while they want negotiated solutions with the US, they are still not just going to carry on trade with China, but increase trade as well. As you said, Spain has been rewarded before. The last trip from Prime Minister Sanchez to China, it has attracted a lot of Chinese investments in the field of renewable energy, a battery plant, the EV sector. We could see more new deals as well on this trip. And this comes as we had seen increased dialogue between the EU and China this week. Two calls being made, one between Premier Li Qiang and Ursula von der Leyen, as well as another video call between the trade representatives from both sides that yielded some significant results. We had a readout from Xinhua saying both sides are looking to immediately start negotiations on price commitments on EVs, which could hint at perhaps possibly the EU considering to lower tariffs on Chinese EVs. We already see Chinese EV stocks bouncing today on the back of this expectation, and certainly is an outreach by China as well to intensify these trade talks with other countries. China said to be hosting some of these European leaders in July, according to SEMP.
Yep, the South China Morning Post reporting on that potential meeting between EU leaders and officials and leadership, of course, in Beijing. Thank you, China correspondent, of course, Min Lo, joining us with the latest as Spain's Prime Minister continues his visit to Beijing. Now, President Trump's flip-flopping has sparked massive swings across the markets, of course, from record losses in US stocks to routes in debt, FX and commodities. Bridgewater Associates founder Ray Dalio told us that Trump's dramatic shifts on tariffs are having an impact on America's reputation as a trading partner.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
Well, let's bring in Bloomberg's Valerie Teitel for the market reaction and analysis. Valerie, to what extent are investors questioning now the credibility of the U.S.?
Look, yesterday's session, especially when it comes to FX and rates, I think was unprecedented, Tom. We saw a huge flight out of the U.S. dollar into other safe havens, one of those being the Swissy. Dollar Swiss saw one of its biggest moves since the Swiss depegged in 2015. A 4% move into the Swiss franc is really starting to pose some questions. Are we fleeing U.S. assets and possibly repatriating them into other currencies? The Swiss was a big mover. Yen was a big mover as well. But take a look. This move is not. This move is continuing to extend, Tom. The euro up nearly 1% so far in the overnight session as we begin to question whether the dollar is acting as a safe haven and if this is possibly permanent damage to the dollar as a safe haven and assets. I want to show you one chart which I thought very surprising is that normally in the past when we see huge bouts of volatility in the FX market, when we see the VIX spiking, it normally goes hand in hand with a surge for dollar assets. We have definitely not seen that in the last week. If anything, we've seen the exact opposite.
We're seeing a breakdown of some of the fundamental assumptions underpinning global finance, and we'll see to what extent that becomes crystallized. What a week it's been, Valerie. We'll take a beat and just kind of take a breath. And you've been front and center on driving our focus, again, around the routes in the debt market and what that could portend. Just as you wrap up what we've seen this week in terms of the size, the scale, the historical context, talk us through where we've landed.
Look, historical swings in all markets, Tom. I want to say that if you're looking at the equity market, you're missing the main point. The equity market was actually up on the week, Tom. The S&P 500 had its best week since Election Day, but that is completely missing the point. You flip on, take a look at this next chart. We're seeing a flee from dollar assets when it comes to the dollar and treasury yields delinking. This is normally something that is only seen in emerging market economies, not an economy that is known as the safe haven status, that is known as the world's reserve currency, that we see treasury yields rising alongside a huge crash in the dollar. This is posing big questions over whether Trump's trade policy is perhaps going to put this safe haven reserve currency status in peril. And with that, the big structural demand for treasuries, many people scratching their heads this morning, thinking that if the U.S.-China trade relationship comes to a standstill, so does China's recycling of those dollars into the treasury market. And does that perhaps put the U.S. deficit on an unsustainable path?
Major questions that need answers, and those answers may not come quickly. 490 right now on the US 30-year. Bloomberg's Valerie Teitel. Thank you. Here's what else to be thinking about today then. 7 a.m. UK time, German inflation data, CPI dropping. We'll break that for you. 1:30 p.m. UK time, we're going to get U.S. producer prices after CPI yesterday came in with a more benign print than some had expected. Producer prices then rounding out the picture in terms of some of the pricing pressures that we may be seeing in the US, or to what extent that may be fading. Of course, much of this coming in, the data, before factoring in the additional tariffs. And today, US bank earnings kick off. We're going to give you a preview of those earnings as well later in the show. Still ahead, EU finance ministers set to meet in Poland to discuss Europe's response to tariffs and the key issue of defence funding. We bring you the details of that meeting. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, EU finance ministers will meet in Poland today to discuss the latest on tariffs and the European response, as well as financing European defence. Speaking at a White House cabinet meeting, President Trump said he views the EU as one bloc for trade negotiation purposes.
They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China. And they said, you know, we're going to hold back a little bit. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States.
OK, just for the record, that is not why the EU was formed. But let's bring in Bloomberg's Oliver Crook right now, who stands by for us in Warsaw. It does seem that the tone from President Trump, at least in that clip, suggests that he has, at least on some levels, Ollie, moderated his view on the EU, something of a reprieve. They are not being hit by these 20% tariffs at this point. How is all this being digested in Brussels?
Yeah, Tom, I mean, he may have been a bit humbled by the bond market and the moves that we've been seeing in the currency market and across the world over the last couple of days, and maybe taking a slightly less aggressive tone when it comes to taking on all of his trading partners, particularly the EU, the biggest trading relationship between the U.S. and the EU in the world. For finance ministers that are gathered here in Warsaw who have a huge docket to deal with, and when you think about the number of issues, the multifaceted issues that emanate from this trade question that has been set off over the last week, I think you can break it up into basically three categories. The first is negotiation, retaliation. What are they willing to put on the table to bring to the Trump administration? They talk about non-tariff barriers. What are they able to and willing to look at there? What are they looking at in terms of the architecture, in terms of forming defense? They are not going to publish early next week, as we had been anticipated, a retaliation to the reciprocal tariffs ever since he rolled them back very slightly. But I can guarantee you they will be coming up with an architecture of how to deal that in the eventuality that this comes back to the fore. The other thing they need to do, Tom, the second thing, is to evaluate the kind of damage that the tariffs that have been imposed will do on the economy. We're dealing with 10% across the board, still 25% on the auto sector, 25% on steel and aluminum. Other finance ministers and economy ministers I have spoken to already have basically no idea the far-reaching impact is going to be, and basically also then how do you support those markets? How do you support those different industries? To say nothing, Tom, of the impacts that we've seen on the markets. I mean, for the EU ministers, we talk about the dollar selling off, long-dated treasuries, yields rising, the equity market in the U.S. selling off. That has an effect here in Europe, where you have the euro up 3.5%, 3.3% over the last 3 days, and the Swiss franc. We'll be speaking to the Swiss president a little bit later today. The Swiss franc is up close to 5% over the last 2 days. That is the biggest move since 2011. So all of these issues have to be dealt with by finance ministers and central bankers here, who, by the way, can't speak because of the quiet period ahead of the ECB next week. But all of this has to be dealt with. Monetary policy, fiscal policy, how do they respond?
Yeah, wow. Talk about being stretched and that support for those particular industries, the auto sector that you flag, being, of course, weighed up with that support for the defence sector domestically within Europe, but also for Ukraine as well. What are you hearing when you speak to people on the ground about that conversation, Ollie?
Yeah, so Tom, listen, this is the other issue that this is initially what you would have thought about this. The only thing they had to really discuss is to figure out financing for the defense sector. We're actually at the Polish Army Museum, and this is a sort of appropriate place to have those discussions because Poland, as you know, is one of the only countries in the EU that is going to now hit 5% of their GDP spend on defense, and that was going to be one of the main issues, and of course supporting Ukraine. So I spoke to the Ukrainian Prime Minister yesterday to get an update for how things were going there, and particularly an update on that critical minerals deal in order to get continued support from the United States. Have a listen to what he had to say.
We have the first draft of agreement, first draft of proposal from the United States this week. I think not later than tomorrow. Our special technical working group will goes to the United States for technical negotiations with Treasury working group, with specialists on the technical conditions of this agreement. I think it will take next week, so we will continue these consultations and we're looking for the best solution. So there are some important principles which are important for Ukraine. So this agreement can't hurt our European aspirations and can't hurt our association agreement with European Union. So this is number one red line which we communicate to all of our partners. It's important. So other issues are connected with Ukrainian constitutions, with international legislation. In the end of the day, it will be international agreement which should be ratified in parliaments of our countries. So I think it will take some time, but we are very intensively cooperate with United States, and I will repeat, our technical specialists, our lawyers will go to United States for very concrete negotiations in person.
Okay, great. And then another question about the sort of military aid coming from the United States. You're still benefiting from aid that was given by the Biden administration. I'd like to get a sense of how much of that aid is left and at what point you're going to have to come back to the United States and talk about another deal.
So you're right. Now we have some support from United States. This support is going to Ukraine according to existing agreements. So we now have negotiations about next steps, but it's still on its way. So there is no additional information for the last weeks and days. But we understand that we have much closer cooperation with European Union, with European Commission. Now we have negotiate about additional financial resources for 2 million big caliber rounds for artillery. We also negotiate about additional supplying and additional production by our joint ventures, military equipment and ammunition to support Ukraine. So it arises our mutual production and supplying everything what Ukrainian defense forces needs today on the battlefield.
Ukraine's Prime Minister speaking to Oliver Crook, who is on the ground for us in Warsaw. Ollie, thank you for the update and bringing us that conversation as well with the Prime Minister of Ukraine. There's plenty more coming up. Stay with us. This is Bloomberg. Now some other stories making the news today. A sightseeing helicopter has crashed into New York's Hudson River, killing all 6 people on board. City officials say the passengers, including 3 children, were from Spain. The pilot has also been killed. The helicopter's flight path shows it had flown around the Statue of Liberty and George Washington Bridge before the crash. It is the latest in a series of recent incidents rattling confidence in U.S. aviation safety. The Wall Street Journal says Chinese officials acknowledged in a secret meeting last year that Beijing was behind a series of cyber attacks on U.S. infrastructure. The report cites anonymous sources saying the startling admission came at a Geneva summit with the outgoing Biden administration. The Journal says the Chinese officials linked the alleged hacking efforts to Washington's support for Taiwan. There's plenty more coming up across the markets, of course. We continue to drill down in terms of the sell-off that we're seeing in treasuries and the dollar. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Friday. These are the stories that set your agenda. The tariff roller coaster rolls on. The dollar extends losses after its biggest plunge in 3 years, with treasuries and stocks under pressure. Futures pointing a little higher, though, as uncertainty continues to rattle assets. President Trump acknowledges tariffs may cause transition problems, but says we are in very good shape, as the White House confirms levies on China are now at 145%. Plus, Spain's Prime Minister visits Beijing today, calling for solid and balanced relations with the European Union. This as China's president reportedly plans to host top EU leaders in July. Checking on your markets then. Futures, as I mentioned, pointing higher in Europe after the gains of 3.5% by the end of the close on European stocks. US markets, of course, under pressure again yesterday. Losses of between 3.5% and 4%. Today, US futures pointing higher on the S&P EMEs by 0.6%. Here in Europe, looking gains of 0.8%. FTSE 100 also pointing higher by 55 points. The Nasdaq 100 also looking to add about 135 points after the losses of yesterday. Let's flip the board because arguably this is where your attention should be. We'll get more analysis with Valerie Teitel shortly. But we went from Liberation Day on April the 2nd, so-called Liberation Day, to Liquidation Day yesterday in terms of the selling across the board of US assets. In terms of equities, yes, but also the dollar and treasuries. Yields continue to grind higher on the 30-year, the dollar at a 3-year low with the euro. Currently, the 30-year at 4.89, a move of around 3 basis points higher in terms of the yields again today. Euro dollar at a 3-year high, 1.13 for the single currency, up 0.9%. The French president has been talking about flows into the EU. The Swissy seeing the biggest jump in a decade, gaining more than 4% yesterday. Currently up 0.4 as well, and building on the gains as that safe haven move. And talking of safe havens, gold gaining in the session, up 1.3%, also benefiting from that safe haven tilt, 3,217. Let's bring in Bloomberg's Valerie Teitel right now for what has been happening across the treasury markets and the dollar. How consequential is this, Valerie, in terms of the moves that you've seen within the historical context and what it tells us about the sentiment of investors?
Look, Tom, I think this week will be maybe go down in history as the first week where we saw evidence of what happens when there's a risk premium built in to the dollar, built in to the treasury market. What we saw yesterday was nearly a crash of dollar assets. We saw FX, the other safe havens clearly outperforming, the Swissy moving 4%. You also had the euro soaring and the yen. We also saw a move out of the treasury market. Many investors are now starting to question, if there is less global trade in dollars, does that mean there's less demand for dollar assets on the back of it? And that represents a real fundamental shift. I also want to point out that just the fact that we're having this enormous volatility in equity markets, we're not seeing any scramble for dollar funding, which has normally happened in the past. And I think that can pose some big questions moving forward. I know we were discussing before. Think about the crisis in 2008. That was a crisis that originated out of the U.S., but we still saw a big flow into dollar assets on a risk-off move. This is now a regime shift. If we go into let's say, an economic disaster in the U.S., if that does happen, we could see capital flight out of the dollar, which is something that you only see, you more often see in emerging market economies, where they almost have to in some way compensate investors for holding their assets with higher yields, with a less bloated government budget deficit. This is, I think, posing big questions on the solvency of the government's spending going forward, because you have to start thinking, if there is less trade with China, China's not going to be buying treasuries. Who is going to be that incremental buyer to step in? A
regime change for the financial markets of the United States. Bloomberg's Valerie Teitel. Thank you. Let's bring in Marija Veitmane now, equity research head at State Street Global Markets. Marija, good morning. Thank you for joining us. Let's pick up with that point then from Val. To what extent, if the genie is out of the bottle in terms of pricing in an additional risk premium, or at least putting a risk premium on US assets like the dollar and the treasury market, presumably that is hard to put that genie back in the bottle.
Yes, good morning. I probably wouldn't go too far yet saying that US kind of financial supremacy has broken completely. Definitely markets are questioning it, definitely dislocating. But I think we probably need to kind of appreciate that investors started the year with quite a substantial position in dollar assets. Investors were very, very long US stocks. Investors were very, very long dollars. So that is definitely getting adjusted. Looking at our data, we see investors kind of squaring up positions. We still don't see huge underweights in dollar build up. Allocation to US stocks has come down quite a lot, but it's still above benchmark, and it's still the biggest position investors have relative to other regions. So yes, we are seeing a lot of questioning of this idea, but according to our data, we are nowhere close to people having given up on US assets.
Okay, this is not a crisis moment then, in your view. How do you think, as you put the lens on the US equity market and factor in the sell-off that we've seen in the 10s and 30s on US treasuries, how are you rethinking the impact that has on the basket of stocks that you have a lens on?
Yeah, no, that's a really good question. So, I mean, what we saw investors have been kind of positioned for tariffs to a degree within their portfolio. So we saw them kind of being underweight tariff-sensitive areas like autos, like materials, some consumer goods. They were underweight like tariff-sensitive currencies as well in emerging markets like Mexico, China, definitely. So they kind of expected that. But the magnitude of the tariff was really unexpected. So yes, investors still had, as I was saying, some overweight in U.S. stocks, overweight in stocks and relative to kind of historical levels, not enough cash in their portfolio. So that's really where the big adjustment is happening. But in terms of kind of long-term fundamental outlook, so if you are an equity investor, what should you do? And like really, you should try to stick to quality companies. You should try to stick to mean wall strategies. And that to some degree what we see kind of the first reaction investors are showing. We saw a lot of buying of kind of defensive stocks, like staples. Healthcare is probably the one that kind of continues to be relatively bid up. Within portfolio.
Yeah. So you look to staples, maybe healthcare. You still, of course, have the prospect of 25% tariffs on the pharma space within healthcare. To what extent do you need to ring fence the China-US trade war? Do you need to be going through your portfolio and weeding out companies that either have exposure to the Chinese market or are reliant on components from China? How much of an exercise is that now in terms of resetting how we think about corporates that have that exposure?
Yeah, no, definitely. That's a big task. I'm sure lots and lots of analysts are busy this day going through that exercise. And I mean, you're absolutely right. And I guess it's not just about China. I mean, yes, China is very much in crosshairs of administration, but with the rest of the world, I mean, we got a pause, great, but it's not like that. It's going away. We still don't have a massive amount of certainty about where trade policy will end up. So de-risking is definitely the kind of the name of the game right now, but with a very clear eye on quality, as I was saying. So, I mean, we're getting earnings season starting next week, so that's probably, I mean, hopefully we'll get a little bit more guidance from CEOs, from managements in terms of how they see those relationships.
Yeah, of course. Although we've seen some evidence that guidance is going to be challenged, isn't it? Given the lack of clarity around what happens with tariffs. What do you do with tech in this environment, Marija?
I mean, tech has been my favorite sector for a long time. It is struggling. I think what is really interesting observation around tech from our custodial database that investors had in summer last year, it was the biggest position investor had in tech post TMT bubble. So you had to go almost like 20 years back to see position as big. So it was very, very, very crowded sector. Now investors sold most of it. So they're barely overweight tech. So position really gone. Valuation obviously adjusted quite a lot. But if we look at underlying fundamentals of the sector, I would still argue that those companies are still enormously profitable. They still high margins. They have lots of kind of stable revenue streams. So I think, I mean, when dust settles, when volatility goes away, I would strongly suspect that would be the sector where investors should be returning.
Okay, so still making the case for US tech. Marija, before we let you go, are you seeing a shift in terms of flows from the US into European equities? If you are, how sustained is that? What are the opportunities in the European equity space?
I mean, that was definitely the trade of the first quarter. So investors were reducing position in U.S. equities and going back to Europe. And in terms of Europe, they started with big underweight position and they closed all of it. But indeed, like it's really interesting. So we didn't think that investors just gone and bought the like cheap and under-owned areas within Europe. They actually bought only two sectors. So that was defense stocks and banking stocks. That was really the move in Europe. And I mean, arguably those positions have already been crowded. I mean, banks has the biggest position investors have right now. European banks has the biggest position investors have right now. As I said, bigger than U.S. tech. I mean, valuation is relative to kind of historical average is quite extended. So I do worry about those positions. So that's to me is the biggest pressure point is the extended European positions.
Okay, some extended positions in some of those favoured European equity trades. Marija Veitmane, equity research head at State Street Global Markets, on how to navigate these equity markets in the current environment. Marija, thank you for your insights this Friday. Coming up, investors' position amid the worsening global trade war, of course. We get more market reaction, this time with Banrion Capital CEO Shana Sissel. That's coming up next. This is Bloomberg. JP Morgan Stanley kicking off earnings season today. What an earnings season it's going to be as banks and other major companies struggle to navigate Donald Trump's trade war. That's playing it down a bit, isn't it? Bloomberg's Charlie Wells is here with a preview. Wow, it's going to be enlightening. It's going to be fascinating, particularly when we hear from executives. What are you going to be watching for?
Tom, it's going to be frustrating and challenging for people who performed well in that prior quarter, particularly traders at a lot of these banks. So JP Morgan and Morgan Stanley, they've got great trading teams, and a lot of the biggest banks in America are expected to post record hauls for this past quarter. But that's the past, and what everyone is going to be paying attention later today is the future and how these CEOs talk about the prospects for their firms, how they talk about not just this trade uncertainty, because we've been seeing so much of that in the banking sector, across the corporate sector, but this political uncertainty, this question of how much can you say about tariffs, how much can you say about what the Trump administration has been doing in the corporate world writ large. And we've got to bring up this note from Michael Semblas. This is making the rounds on Wall Street. It is a redacted report from a few days ago. This analyst, he's been in the industry for about 30 years. He talked about how this is the first time he feels like he cannot say certain things for fear of offending people's political sensibilities. And that letter is really striking. You just see so much black there on that screen. And this, was not an earnings report. This is not a forward projection, but it speaks to the challenge that executives and analysts have as they navigate this new political regime as well as this trading regime.
It's remarkable. This is not a note from the FBI. This is not an analyst note out of China. I remember when I was in China, analysts having to watch what they said and putting out analyst reports that had to align essentially with China's government policy. You're seeing echoes of that now in the United States. It's remarkable. Charlie Wells, thank you very much indeed with what's happening in terms of how analysts watch their words around risks and threats and concerns from the Trump administration. Of course, the preview as well of the earnings season with banks kicking off later today. Now, the dollar extending losses after its biggest plunge in 3 years, while stocks and bonds sell off as a worsening global trade war erodes already fragile appetite for risk. Let's bring in Shana Sissel now, CEO of Banrion Capital. Shana, good morning. Thank you for joining us, at least good morning out of London. What do you say in terms of, are we seeing a regime shift when it comes to investor views about U.S. assets? When we look at the sell-off in U.S. Treasuries, particularly at the long end, when we look at the sell-off of the dollar, is this a regime change now?
I think it's too early to tell. A lot of people want to say it's a regime change, but one of the things I think hasn't been mentioned, and I've been watching your programming most of the evening because it's the middle of the night where I am. And I can say that one of the things that hasn't been mentioned is that at the end of the day, the U.S. consumer is a massive driver of the global economy. And it is the primary driver for why the U.S. has some leverage here. It's why the U.S. is always at a trade deficit. And so I think that we can't underestimate the power of the U.S. consumer and the power of the U.S. ingenuity. What it is doing is providing opportunities for potential competitors to come in other areas. And I saw you were talking about Spain earlier as it is pertaining to becoming a stronger trade partner with China. And those things are certainly happening. But I don't know that is necessarily a bad thing. It's a painful thing. But I do think a broadening of economic activity across the globe is better long term for everybody. And while this is quite a painful experience in the moment, it's very much too soon to say that it's a regime change.
Okay, too soon to call it a regime change. Do not underestimate the power of the US consumer. Shana, do we though need to be pricing in some risk premium into at least some parts of the US asset space? Is that fair to assume that there will be a risk premium now priced in by investors to treasuries, to the dollar?
Absolutely. I think that there has to be. There's a lot of risk right now, and we're seeing whipsaws in the market because it seems to be changing every day. Markets hate uncertainty, and that is not helping. And in terms of treasuries and foreign investment in treasuries, I think that having a risk premium is an important aspect. And quite frankly, this presents a problem for the Federal Reserve here in the U.S. And I think that this activity is actually what's kind of forcing the Trump administration's hand. I think that's why you saw them take a very quick pivot, because the bond market is letting them know that the stance they were taking was not a favorable one. And we really need interest rates to come down here in the U.S. and the Treasury markets are not cooperating because of all the tariff threats and foreign investors staying out of U.S. Treasuries.
Shana, what buying opportunities are you seeing amid some of these dislocations?
So this gets me excited. As an investor, a long-term investor, every time in my career that I've ever made massive amounts of money, it's been in markets like this. And I think that as investors, anybody who wants to think about themselves as an investor, are they a good investor or not? It's the markets that are in stress that tell you how good of an investor an individual is. So for me, I'm looking at the longer term trends where tariffs, no tariffs or whatever, there are companies that have competitive advantages that will win in the long term. So I'm looking at some of the AI related stocks. So stocks like Vertiv, stocks like Marvell, stocks like NVIDIA, and looking for ways that I can buy those stocks at massive discounts to where they were today. If I think about how this played out in 2008, the things that you were able to buy at huge discounts, particularly in the tech sector, ended up taking off like a rocket ship as we came out of that. So I think that the opportunities are going to be in trying to figure out who the winners and losers are going to be. And I think that we would be remiss if we didn't look overseas at the international markets. You know, we're coming off over a decade where U.S. markets have dominated. And that's not necessarily how it's always been. Having a regime change to having foreign and non-U.S. stocks in non-U.S. countries outperforming would be a good thing. So taking a look at on a country level, I'd be looking at stocks in South Korea. I'd be looking at opportunities in Vietnam and some of the European stocks that will benefit from being able to have better trade agreements with foreign partners because the U.S. is using tariffs as a threat and not making friends with our allies.
Shana, just briefly before we let you go, give us some names in Europe then that stand out to you at this point.
Oh, you're going to ask me to give names in Europe as if I follow European stocks. No, there's some healthcare stocks in Europe that I think are favorable. If you look at like a Novo Nordisk or an AstraZeneca, things of that nature, which are headquartered over there, I think that those are names that I'd be looking at in the pharmaceutical sectors. I think they're less likely to be impacted by tariffs. And so those are some of the names I'd be looking at. Not necessarily technology, but if you think about names where there's a demand for the product or service, and it's going to be something that's favorable. Tariffs, no tariffs, people will pay up for pharmaceuticals, especially those that are life-saving, and that's where I'd be focusing. In the healthcare sector, in particular, is an area I think is very attractive.
Shana, thank you so much indeed for staying up for us very early, of course, where you are in Chicago. Shana Sissel, with a view there that we should not underestimate the US consumer. Maybe some opportunities as well to add to US tech, opportunities in European healthcare. The CEO of Banrion Capital. There's plenty more coming up. Stay with us. This is Bloomberg.
think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable.
We have to make some difficult choices. We might have to go through a brief recession in order to rebuild our foundation.
If we do get a proper recession, the S&P likely bottoms at about 4,600, 4,700. We didn't get to that level. I think a deep recession is off the table for now. If we can stick at this 10% tariff rate.
I think I've already moved to recession with a capital R. I think it's going to be deeper. I think the friction that's going on globally is going to cause a global recession, and we're not going to be spared.
Okay, recent guests on global recession risks, of course, with a lens on what's happening in the US. The moves within the FX space yesterday were pretty pronounced, weren't they? In terms of 1-month risk reversals, just as an indicator of how bearish traders are now on the US dollars, the most bearish in 5 years. You saw that, of course, reflected in the moves in the Swissy yesterday. Let's flip the board and have a look, because the move was up more than 4% on the Swissy versus the US dollar yesterday. Those gains continue on that safe haven tilt, and arguably as well rolling out investors out of dollar assets. You saw that pronounced in terms of the treasury moves and the dollar yesterday. In terms of safe havens, let's flip the board and have a look at gold, because that is back near record highs. The yellow metal gaining on this uncertainty around the path ahead for the Trump tariff story, with 145% right now, of course, in terms of the impact on China as we count down 90 days in terms of these potential negotiations with up to 60 other nations. So you're seeing gold rallying once again. That is the haven bid, along with the Swissy, along with the euro, and along with the yen. You've got to wonder to what extent that is going to be comfortable for central banks in Switzerland and at the ECB in the days and weeks ahead. The opening trade is up next. They have more great analysis on all the significant shifts we're seeing in these global markets. Stay with us. This is Bloomberg.